Okay, so basically we have two ways of calculating bad debts. First is direct from trade receivable, and second is we make a provision and then cancel off the bad debts. Okay, so first of all we have trade receivable. Okay, and what here we can see is we will have a balance on debit side. Okay, we will have a balance on debit side. So assuming you have a trade receivable and you think he's not going to pay. When you think he's not going to pay, you cancel off the account by crediting it to bad debts. So that means now you zeroize the account and you know that he is not going to pay you. Now what happens when you credit this is you are debiting bad debts, and at the end of the year you put the amount into income statement and zeroize this account also. Okay. Second of all, we have provision of doubtful debt. Provision of doubtful debt is we take a certain percentage which we think we will not be able to collect, or we estimate that these people will not pay us at the end of the period. So we are just estimating. It's not that this amount is actually going from the accounts. Okay, so we think that, or we estimate 5% of total trade receivable will not pay us in this year. Okay, so we take 25,000 and we take the percentage and we multiply, and how much amount we get here is 1250. So in this scenario we think we will not be able to collect 1250 from our trade receivable. And what do we debit and what do we credit? So we debit income statement as expense and we credit provision of doubtful debt. Okay, so always remember, whenever we have provision is always credit. Okay, provision always have a balance on credit side. If you see, balance brought down is always on credit side. Even for depreciation, all the provisions are on credit side. So when you transfer the amount, you credit this and transfer the amount into income statement, you will have a balance carried down at the end of year, and then balance brought down next year. Okay, so next year, let's say your trade receivable increased to 30,000. Your trade receivable increased to 30,000 in year 2. That means your provision stays the same, which is 5%. Okay, we take 5% of 30,000, which is 1500. Now what we want is our balance carried down to be 1500. Now here we want our balance carried down to be 1500. First year also we want our balance carried down to be 1250. Okay, and the balance we put in the income statement. Okay, so here when we calculate 5% of 30,000, which is 1500, we make it 1500 on this side, and we have a balance brought down on credit side, which is 1250. Now the balance we will put in income statement, which is 250. So we will debit income statement and credit provision of doubtful debt. Now what does it mean? It means from 1250, okay, it increased to 1005 this year. From last year it was 1250 and now it's 1005. So it increased by 250. So we can write under income statement as increase in provision. So there is an increase in provision. Then next year, let's say our trade receivable decreased to 20,000. So when our trade receivable decreased to 20,000, we take 20,000, take the 5% of it, which is 1,000. Okay, if you see 20,000 times 5%, it's 1,000. We get 1,000. So we want our balance carried down to be 1,000. Now from last year it's decreasing to 1,000. We will write 500 on this side, because if you calculate this side is bigger. Okay, so we make this side equal to this side, which is 1005. So 500 is missing, so we write here 500. So we debit provision of doubtful debt, we debit here, see, debit side, and we credit income statement. But this time it's not increase in provision. If you see, it's decrease in provision. From 1500 it decreased to 1000. It decreased 500. Okay, so there is a decrease. In this scenario there is an increase because from 1000 to 50 it increases to 1005. Here it decreases from 1005 to 1000. Now moving on with bad debts recovery. Bad debts recovery means you thought someone will not pay you, but now they pay you. Okay, when you thought someone will not pay you, you did something like this. You had balance brought down, you thought they will not pay you, you credit the amount. Okay, now let's say they paid you. Okay, after this, so maybe in second year you thought I will not pay you, but in third year I paid you. So there are two ways of doing this, like this or like this. So when I pay you, what happen is I credit the trade receivable. Okay, I credit here trade receivable and I debit my bank, correct? But what happen is when I do this, I also have to zeroize the account. So it means I have 6000 on this side balance and I have nothing on this. So I need to make another entry to bad debt recovery account. I will open a new account with the name of bad debt recovery. Okay, I have here. So I will open, okay. So I will open another account with bad debt recovery here and transfer the amount here. So I will debit trade receivable and credit my bad debt recovery account, and at the end of the year I will transfer this amount to my income statement, okay, as an income, because I did not expect I will receive this amount, but I have received this amount. Okay, now second way is I directly debit my bank, because when I pay you, you receive money, you debit, your bank balance increases, and I credit my bad debt recovery. Okay, so I don't do this. I let this account stay as it is. I don't do this. I directly do 6000 here, 6000 here, and like, okay, I do this. So instead of trade receivable, I directly make this entry, which is easier for me to do. Okay, now this is how you do bad debts recovery. So question 2 is based on bad debt, question 3 is bad debt recovery, question 5 is provision for doubtful debt. Those are very simple questions. You can try and see if you understand the concept, so we can move on with a bit more complexity. So that's all for this chapter, and if you have any questions, just let me know.